I want to bring another voice into this conversation. Let's bring in CNBC senior economics reporter Steve Leisman. Steve, great to have you here after Fed decision day. Just give us a sense of what you think about what we heard from Jay Powell after the decision, and then what we heard from Janet Yellen that seemed to kind of muddy the waters for the market.
Yeah, so I'll take them separately. I think that Powell threaded the needle reasonably well. I mean, he's got a difficult tension right now between the inflation problem he has and the rising credit issues in the economy that may have been put to rest, at least for a little bit, but I think they're still going to be there. And he has this issue of credit tightening that's going to be coming down the pike. And some people thought it would have been enough to stay his hand, but he took the quarter that was given to him. And now pretty much what Josh was saying, I'm looking at the same thing. I see more of a 50-50 split now between doing that quarter. But what's more interesting, guys, is looking at the debate right now over what happens in June. I want to show you that June contract right now, which is 25, 50, 25% probabilities, 25 for a cut, 50 for staying standing pat, and 25 for a hike. So there's there's the May probabilities. And guys, I don't know if you have the next 3 bar chart that we put together, which was the what's happening in June, which is really fascinating, and it shows that there's a market out there. You know, you pick your point, and you can go with the consensus, or you can go with the right tail or the left tail on whether the Fed does another quarter. That's where we're at. I'm also interested in the gap, right? Yeah, Frank, just one more thing, which is that there's just 1 percentage point gap between where the market thinks the Fed's going to be year end and where the Fed thinks it's going to be.
Oh, sorry, Steve, I didn't want to interrupt you. I just want to kind of speak to while we're looking at your charts and letting load about just these differences of opinion. We're looking at JP Morgan today saying continue to look for one more 25 basis point hike in May, then an extended pause before easing next year in Q2. Barclays, their call unchanged. FOMC to hike another 25 in May to bring the target to 5, 5.25. Then they expect a pause. Goldman's hot seats, peak funds rate unchanged at 5.25, 5.5, then another 25 points in May. What do you make of all these differing opinions, thoughts of a pause? I mean, there's just so much out there.
So I'll tell you what I was doing this morning, Frank. I wasn't reading those guys. What I was doing was talking to some former Fed officials about how in the great financial crisis they gauged credit tightening. And so this is now the new metric, right? This is now the new CPI when it comes to figuring out. And I've got a chart there which maybe talks to what Josh Brown was talking about, was what's happening to tight credit standards at the banks. And you can see this is a quarterly report, which is what we have now, that even before we got into the particular mess we're in right now, banks were already tightening credit, and that's going to be the key right now. It's not as bad as it was either in the pandemic, or if you went back further with this chart, back to the great financial crisis. But those standards are higher and are tighter, and so that's going to mean a reduction of credit. And now what we got to think about, and I'll bet Stephanie's thinking about this already because she's the kind of person that would think about this stuff, is how do you translate that into GDP, into consumer spending, into businesses? What I did look at, Frank, was look at the senior loan officer survey where that data comes from, is that it was big banks and small banks, it was commercial, industrial, it was land. The only thing they're not tightening credit for right now, and again, this is data that predates the recent banking turmoil, the only thing they're not tightening credit for is mortgages. Everything else is tighter, and that's going to have an impact on the economy down the road. And so when you get happy, I just want to note a caution, Frank. When you get happy about the fact that the Fed is doing less, make sure you understand what you're getting happy about, which is the idea that there's going to be tighter credit and a downdraft from that in the economy.